Investonomics from ICICI Securities with me, Prayag Gawande. Today, we have something very new and unique for you. That is the product of Freedom SIP. So in today's webinar, we will talk about the future of investing with this new dynamic and unique product from ICICI Prudential AMC. Hosting today's webinar is our very own Mr. Prakash Salian, Vice President and Head of West Region Select Branch Network. And our guest speaker of the day is Mr. Chintan Haria, Head Products and Strategy for our group company, ICICI Prudential AMC. So without any further ado, over to you, Prakash sir.
Hi, good morning, Chintan. How are you doing?
All well, Prakash bhai. Good morning.
Good morning. So, with current volatile market, so my question to you is that what you recommend or what you suggest, mutual fund lump sum or SIP?
Sure. So I think post the pandemic breakout and with easy liquidity, we have got used to low volatile world for the last maybe 24, 25 months. But I think with the interest rate scenario changing, where we are seeing interest rates going up in the global world, and that will obviously get reflected in India as well. What does it show? It shows signs of economic upturn happening across the world, and hence the inflation is also going up, which is what probably is making the interest rates globally go up. For India, at least, the good part is that the growth story continues. I think if we see the numbers in terms of GST collections, in terms of export growth, in terms of domestic sales, it is looking reasonably good. And with the monsoons expected to be normal and the international crop prices going up, the rural economy, which was in distress, if that turns, then at least we have one more lever which helps India in terms of its growth. Are we going to see volatile times in the next year or so with the interest rates going up? The answer is yes. And hence, while equities generally also is an asset class which is normally volatile, I think all asset classes in the next 12 months to 18 months will remain volatile. But I don't think investors need to worry. If they have a plan in mind and if they apply their asset allocation right, with the right products, right features, then I think their journey of long-term wealth creation will be well taken care of. Thank you.
So great. Thanks for this valuable input. So what as an AMC was your objective when you created solution like Freedom SIP?
Sure. So I think apart from the fact that there's greed and fear which impacts all of our emotion, and that's where the asset allocation schemes like the asset allocator fund or the balance advantage fund become handy tools for investors. We also saw that people save every month, people want to invest every month, but they don't know exactly how to do it. And more importantly, how much to do it or how much investments to make via systematic investment plans and for how long. So we felt that they do not have a clear objective in mind in terms of how much money they would need, what is their goal. And that's where the feature of Freedom SIP takes into account the tenure, how long your SIP should be. It takes into account that after the SIP period is over, how much money do you want systematically to come to you every month? And that's where the whole package in terms of the tenure of investment, how much money do you want after the tenure of investment is over, which will determine the actual SIP amount currently, which also help you to right size your current SIP and probably force you to save more, which is a very important thing in today's day and age.
So which schemes do you think should be opted as a SWP post completion of Freedom SIP?
Yeah, so before I move to the schemes, I'll just explain the concept of Freedom SIP for investors so that they are basically aware what we are talking of. So Freedom SIP is a simple feature. All of you would have SIPs, and we've seen that SIPs as an investment mechanism becoming extremely popular. And the good news is that markets have had their ups and downs, but Indian investors in the last 7-8 years have never stopped their SIP journey. So they've continued their SIP journey. And that is exactly why SIPs should be a part of your portfolio, because SIPs in the long run help you to average out your costs, help you to wade through volatility, help you to basically grow your wealth in a systematic manner. And that's why SIPs have already become a very integral part of all investors' portfolio, as can be seen from the fact that more than 11,000 crore worth of SIPs are happening every month from the SIP route. Now, as an addition to that, it would be nice if, for example, someone told you that if you invest X amount for 12 years and after that you could take out 2X, you knew exactly that, okay, 20,000 rupees I want to take out after 12 years maybe. And hence today, if you can invest 10,000 for next 12 years and take out 20,000 rupees every month, that's what basically Freedom SIP is all about. It basically provides a platform assuming a certain rate of return that the markets will generate. You invest today for the next 12 years, 8 years, 15 years, depending on the tenure that you choose. And then you can basically take out multiple of whatever you're investing depending on the tenure, which will help you basically achieve your goals as well as save more currently and for a longer period of time. So you will have saved for a longer period of time, you would have invested the right amount, and at the end of the tenure, depending on your goal and the amount of money that you want, you would also get the cash flow that is very important in our lives. And that's what Freedom SIP does to you. From a source scheme and destination scheme, of course, you have to choose the scheme in which you are starting the SIP. We believe that any equity scheme, if you start your SIP with, or any hybrid scheme you can start your SIP with, it is totally dependent on your risk profile, and there your relationship manager will definitely help you with the input. That can be your source scheme wherein you are investing the SIP. Then after the SIP period is over, you can either continue with the source scheme. There are certain selected source schemes which are there, which you can continue as well. Or after the period is over, you can move to defensive schemes in the asset allocation category, which then from where the money will come to you every month via systematic withdrawal plan. So effectively, you invest in a source scheme, which is an equity scheme or a hybrid scheme of your choice, depending on your risk profile. After the tenure is over, 8-year, 12-year, 15-year tenure is over, you can either move to a defensive scheme, which is in the hybrid category, or continue in the hybrid category, asset allocation category, depending on your choice of source scheme. And after that, you will be able to withdraw, or you'll get the monthly cash flow via withdrawal, which will be a multiple of what you're investing to meet your goals. It's a very simple process. I would recommend that you can basically pick up any equity scheme, because in the long run, equity schemes through the rupee cost averaging helps you, and then move at the end of your tenure to a scheme like asset allocator fund or the balance advantage fund, which is a asset allocation schemes which help you to protect downside when the markets fall, because of their simple mechanism of buying at market lows, selling when the market's going up, and a valuation-based model that they follow. And then you will obviously be able to take out the money in a systematic manner after your tenure is over through the balance advantage fund or the asset allocator fund. There are other schemes also which are approved for source and destination, but I would think from a destination standpoint, for most of you, the asset allocator fund and the balance advantage fund would be a good destination scheme. The source scheme can be any of your choice depending on your risk profile.
That's great. So what could be taxation for our clients who opt or invest for Freedom SIP?
So since this is just a feature, the taxation does not change. It is pretty much, if you're investing in an equity-oriented scheme, it will be equity taxation. If you're investing in hybrid schemes which have equity taxation, there also you will have equity taxation. So if your source and destination schemes are equity schemes, which are equity tax-oriented schemes, you will be in the same equity taxation, which essentially is, if you hold for less than 12 months, it is 15% plus some cess, etc. And if you hold for more than 12 months, you will be taxed at 10% plus some cess. So that does not change. It is a feature which does not change the taxation of your ultimate investments in the source scheme and destination scheme. They continue to remain the same as your source and destination scheme, depending on your time horizon.
Okay, great. So with current sudden increase of 40 basis point, so it is similar to the Federal Reserve rate increase, and what impact is expected on Indian capital market, keeping in mind increase in price of crude and etc.
So no doubt that inflation, because of easy liquidity and 0% interest rates virtually in the world for 2 to 3 years, there was a significant demand uptick which happened in the world. The economic growth happened, which led to the agri-commodity prices, the commodity prices, the equity prices, all of them going up. Even oil we've seen recently in the last few months going up sharply, which has led to inflation coming back into the world economy, which was missing for last 4-5 years. With inflation coming back, which essentially is signifying that there is growth which has come back in the world, there is a high likelihood of interest rates continuing to go up. And I think most of us should accept that fact that interest rates were very low globally, which was not sustainable. In fact, it was not even healthy. So globally, we are moving towards a healthier interest rate environment, which is more sustainable. Will there be volatility in the markets? Will there be certain corrections in the global markets? The answer is yes. But from an India standpoint, we never saw Indian interest rates go down so sharply. we saw Indian interest rates were normalized. Yes, the Reserve Bank rates were lowered to help growth when the pandemic struck. But if you look at the Indian 10-year GSEC, etc., that actually reflected the interest rates, and in Indian interest rate context, the interest rates were not very low relative to the inflation, relative to the rest of the world in terms of comparison. So we don't have to worry too much about inflation in India because our interest rates never fell that much. And even if you see the 10-year right now, which is hovering at around more than 7.2, 7.3, it is reflective of the fact that interest rates are going to go up. So we have already priced in, I would say, that interest rates in India are going to go up. And more importantly, the investors should probably focus on the fact that among the global growth oriented countries, which are large, India in the next probably 10 years will have a working population which is growing because of our focus on domestic manufacturing increasing and our relationship with most of the global countries being good. We are a destination of choice when it comes to exports. And so apart from the short-term ups and downs which will happen because of global markets, our country is in a reasonably good space when it comes to the growth forecasts which are there, which will help our equity markets also do well, and interest rates on bonds, if they have already increased, that will also stabilize. So from an investor standpoint, more important is to have the right allocation, avoid the risks which are there in some of the unknown investment avenues which have come up, and also those avenues which have gone up too sharply, or those investments which have gone up too sharply because of the 0% interest rate world in which we are, where easy capital was making some of the stocks, some of the asset classes very expensive. So I think with the core focus that we have on Freedom SIP, it will be a brilliant long-term tool in the hands of investors to have a objective in mind, a plan in mind, a goal in mind in terms of how much money they need to save, how much money they need after a particular point of time. And that will help bring discipline in your long-term investment avenues. So without having to worry too much about what's happening globally and locally, because frankly, none of us can control anything, as we've seen, right? We cannot control wars, we cannot control inflation. But what we can control, of course, is the fact that how we invest, how we save, and that is extremely important as I see it. Thank you.
Very true. So thanks for your valuable and enriching inputs what you have given to us and our clients. So thank you once again, Chintan, for this.
Thanks a lot, and it's always a pleasure. Thank you.
So truly, this looks like the future of investing. And as we evolve, so should our investments. From what I can understand, this product would cater across all ages and fulfill all requirements of today. So not just goals, but planning is also quite important. Retirement planning is the first thing which comes to your mind when you think of a freedom SIP. However, you can also start early for your child and ensure that they have no problems with their pocket expenses beating the inflation. Going deeper, you can plan your freedom SIPs so that the SWP amount can cover your EMI in the future, so that your loan absolutely becomes free. So there's not just one way, in which you can look at freedom SIP as a product. It has an array of usability scenarios which can cater to a wide range of audiences. So as a special vote of thanks to our guest speaker and audience for attending this webinar, and please do not forget to share, like, and subscribe to our Twitter, Facebook, and LinkedIn handles. Have a pleasant day ahead and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.